Okay, tonight is the statewide online synchronous seminar for Accounting 101. We will be covering Chapter 12, Statement of Cash Flows. The main reason that we need to talk about cash flows at this point in the class is if you are an accounting major, you will be performing cash flows somewhere down the line, and you need to have an understanding of how you actually create a cash flow and the construction of that cash flow. If you are a business manager or an office administration manager, and this is your required course because of that, you need to be able to review and look at that financial statement and be able to explain what it's telling you. Not so much know how to construct it, but to be able to explain why it's telling you. So the main purpose of a statement of cash flow is that it actually reports. It would, you could see the slides much better if I actually put them in slideshow view, so that's probably a good thing to do here. I'm sorry, I'm not feeling well today, and it makes me even foggier than I am other times. So at any rate, the statement of cash flows reports the cash flows. It tells us what our cash receipts are and what our cash payments are. It covers a period of time, either a month, a quarter, or a year. So whenever we are doing our financial statements for that period, if we are a company who prefers to do just quarterly financial statements, then we would just report our cash flows for the quarter. But most corporations have to report their financials on a monthly basis, and then they report them quarterly to be audited. So, it's looking at the inflows and outflows of cash. Basically, you start with your beginning cash balance, and you look at what made up that balance. So you use your balance sheet to see where your differences in cash is. Did my cash increase over the year, or did my cash decrease over the year? And then what made that net amount of change happen? So you've probably spent, for corporations, millions of dollars of cash have come in and gone out. But we want to look at each one of those activities to see what caused that all to happen. We want to make sure that we are actually increasing our cash based on operations, and that we're not increasing our cash because we keep selling ownership of the business through stock, or that we haven't borrowed a lot of money, or else that we haven't sold a lot of our long-term assets to keep the company afloat. Those are the types of things that it tells us. So when we're doing a statement of cash flow, we're looking at the cash account, and that cash account actually includes our cash equivalents. If you remember the very short-term T-notes, anything that had a maturity date of 90 days or less, we considered a cash equivalent when we talked about that in the cash chapter. So the purposes, we want to predict our future cash flows. One would expect that, depending on how the company was doing today, that unless there were some changes that we knew about coming up, we would expect the same type of performance in the future. We can evaluate management decisions, like, did they decide to buy new equipment when they couldn't afford to buy new equipment? Did they decide to sell equipment when they should have kept that equipment? Did they give up ownership when there was no need to? Were they paying dividends when they were really a little short on cash to be paying dividends? And and that's where that determines the ability to pay dividends and interest. Is there enough cash flow from operations to do that? Because we really don't want to be dipping into our retained earnings just to pay dividends or to pay interest. And it also shows the relationship of net income to the cash flows. And again, this is where I said it's important to know if the business is staying afloat from their operating income alone, or are they having to dip into other resources to make that happen? This slide just shows a little graphic of when we would create the financial statements and the time frame that these flow, and this will help you. This will help on the final exam too, because you have to remember that not all financial statements are created for a period of time. Some of them are as of a specific date, and the balance sheet happens to be the one that is a specific date or a point in time. When you create your balance sheet, your date on it will say December 31st, 2014 or July 31st, 2014, whereas the income statement, statement of stockholders' equity, and statement of cash flow all are for the period of time as is depicted at the top for the year ended, or it could be for the month ended, and the date is for the whole month or for the whole year, not as of that specific date as the balance sheet is. There are three different types of activities that occur in a business. You have the operating activities, the investing activities, and the financing activities. These are going to be the three sections on your cash flow when you prepare your cash flow statement as well. So from operating, it's the revenue, expenses, gains, and losses that went into the business. That's your net income, what has created your net income. We will analyze those activities and those accounts to determine what our cash basis of operating income is. Investing is the cash flow that's related to long-term assets. So this is where if you purchased equipment, you would have less cash. If you sold equipment, you would have more cash. If you had a long-term investment in another company, you would lay out that cash to get that investment. When you receive that investment back, you would get cash back. So if you spend the cash, it's a negative. If you get the cash, it's a plus. Pretty simple. The investing and financing are pretty straightforward. You just have to know which activities fall within those. Operating is a little more confusing. So financing is the cash flows are related to long-term liabilities and owner's equity. So this is going to be your issuing of new stock, which would bring cash into the company. Paying dividends, cash would go out. If you repurchase treasury stock that we learned about in the previous chapter, in Chapter 10, we learned about treasury stock being the company's own stock that had previously been issued and they went out and purchased it back. When they buy that back, they would have less cash. If they resold it, they would have more cash. If you borrowed money in a bond payable, you would have more cash when you borrowed that money, less cash when you paid that bond back. A long-term note payable. Again, when you went to the bank and you borrowed that money, you increase your cash, but when you pay it back, you decrease your cash. Those are all financing activities. So if we can think about how these items affect the balance sheet, it sometimes helps us to make sense out of the cash flow statement. I would tell you that the first time you're introduced to trying to create a cash flow, if you just follow the rules or set forth for creating the operating section, it will help you so much. If you can just, it's like the rules of accounting. If you can say, okay, it tells me if it's an increase in a current asset, then I need to subtract it, then just do that. Because this is truly just an introduction to how cash flows work. If you're an accounting major, you will hit this much deeper in your intermediate accounting class. And then if you continue on for a bachelor's at some point, then you will again hit it over and over. You will hit cash flows. It's a much more complex topic than what we make it in Accounting 101. So how do operating, investing, and financing activities affect the balance sheet? Well, the operating section is your current assets and your current liabilities. You look at how those items change, the change in those items. So again, I had said earlier, I want to bring my net income back to cash basis. Remember, we are doing accrual basis accounting in this class. Anytime that you see an accounts receivable and accounts payable on your book, receivables or payables of any kind, that means you're doing accrual accounting, because cash basis you just record when you pay the cash or get the cash in. So investing, how does that affect the its long-term assets on your balance sheet? And financing is your long-term liabilities on the balance sheet and your stockholders' equity section on your balance sheet. Ooh, I almost knocked my laptop on the floor. Okay, there's two different formats. There's the direct and indirect method. The indirect method is easier to do. The direct method is preferred by GAAP because they believe that the information is more useful the way it's presented. So what's the difference in these two? With indirect, we reconcile from net income to net cash provided by operating activities. With the direct method, we report all cash receipts and cash payments from the operating activities. It's just two different approaches. Remember that as we go through cash flows, if you are doing a cash flow under the indirect method or the direct method, your cash flow would end up exactly the same in the end. Your financing and investing sections are exactly the same under both methods. It's only the operating activities section that is different. So you notice here when we use the indirect method, we start with our net income and we make adjustments. In this example, we added back depreciation to get our net cash provided by operating activities of $900. We would add back an item like depreciation because depreciation is a non-cash outlay expense. When you put depreciation on your books, the entry is depreciation expense debit, accumulated depreciation credit. So there's no cash involved in that transaction. So it's a non-cash outlay expense. Likewise, that happens with any kind of amortization, any depletion. If you have a loss, it's a non-cash outlay, and if you have a gain, it's a non-cash gain. I mean, it's a paper gain if you sell a piece of equipment and there's a difference in its book value and the amount of cash that you get. When we use the direct method, it is we would list our collections from customers. That can be determined by looking at your accounts receivables, by the way, and we would look at our deductions being the payments to suppliers by looking at our accounts payable to get the same operating activities cash in both methods. This is a very basic. It becomes more complex than this. So a little bit ago when I said that the best thing to do is to just kind of go with the flow like the rules of accounting, maybe we don't understand why at this point and can't get our heads wrapped around the reasoning of why I would subtract a gain or add depreciation or add a loss or why I would add a decrease in current assets. Maybe that just doesn't make any sense at this point in time. I hope to help it make some sense before the end of the evening. But this is the example, this Exhibit 12.3, which you can pull right from your textbook. Let me see what page it's actually on. I've got the book in front of me, and I know you guys are using ebooks, a lot of you, and that makes it harder. So on page 670 then of your ebook, you would be able to pull this chart, and this will help you to know whether to add or subtract the dollar difference when you get there. So this is following the indirect method. Very good resource. Okay, when we're doing the indirect method, we want to make sure that we add the net income, we add the depreciation and amortization, we would add a loss on any long-term asset, we would add a decrease in current assets other than cash. So if I had a decrease from my beginning to ending balance in accounts receivable, inventory, prepaid expenses, supplies, any of those accounts that are current assets, if there's a decrease from what the beginning amount is and the ending amount is, then we would add that amount. And then if there's an increase in current liabilities, same thing. If my beginning accounts payable is 1,000, my ending accounts payable is $1,200, then I would have an increase of $200, and I would add that. This is just a summary of the chart that we just looked at in words. We're putting it in a different format. So we would subtract a net loss. So that's, instead of having a net income, we would have a net loss, different than a loss on a sale of a long-term asset. If we have a gain on a sale, we're going to subtract that. If we have an increase in current assets other than cash, we will subtract that, and we will subtract a decrease in current liabilities. Again, I will try to put some sense into this. But as we think about, again, I said that depreciation is a non-cash outlay. We had subtracted that depreciation expense from our net income. So if we want to remove the effect of that expense that was non-cash from our net income, we have to add it back, therefore zeroing it out. And that's the thought process. If I had a gain, then I had added that in to make my net income higher. So I would need to subtract that same amount out to zero out the effect of that gain because it was a non-cash transaction. Okay, under investing, again, I said in this case, if we were bringing cash in, we just add it. If cash is going out, we subtract it. We don't have to worry about, I'm not sure why I'm dinging here. We don't have to worry about whether, oh, was there an increase so I added or subtracted. It's just if I sold a plant asset, I got more cash. If I sold an investment, I've got more cash. If I collected a receivable, I have more cash. So those are all positive. I add them. For negative, if I purchased or the acquisition of plant assets, I went out and bought something, I spent cash. I bought investments that are not cash equivalents. I spent cash. That's a negative. I made loans to others, right? That would put a receivables on my book, but at the time that I'm making that loan, that is a negative to my cash. Financing, I went over this briefly. If I issue stock, sell treasury stock, borrow money, I will have more cash. To take cash away, I would pay dividends, buy treasury stock, or make a payment on the principal of those debt. The interest payments are operating expenses, by the way. Okay. So let's prepare a statement of cash flows using the indirect method. We're going to look at the Roadster factory. It's a dealer in auto parts for sports cars. We're going to use a comparative balance sheet for 2014 and 2013 and the income statement for 2014 to prepare the statement of cash flows. So again, this is in your textbook. This is an example right out of the book. It's on page 672. If you can pop up your page 672 on your screen too, then that would be so you could look at the numbers as we move forward. Okay, and this is the income statement from 672. I'm clicking ahead here, reading my own mind here. Okay, so from the cash flows from operating, again, these are the transactions that make up the net income. So we are going to pull from the income statement the net income, any depreciation, depletion, or amortization, and the gains and losses. And from the balance sheet, we will look at the increase or decrease in each current asset and the increase and decrease in each current liability. So we use both the income statement and the balance sheet as shown on page 672 in your book to construct our cash flow. Again, here's the little chart where we looked at about adding what we added and what we subtract to get to our net cash provided or used by operating. And then we move on forward to actually construct this. So to construct the, we're just going to look at the operating section right here. So to construct the operating activities, we would, using the indirect method, we start with our net income. So to pull your net income, you would look at your income statement, and you see that you have, again on page 672, the $50,000. So that's your starting point. And again, we're going to adjust this to reconcile net income to net cash provided by operating activities. Let me stop here and just say, cash flows are something that accountants like, because cash flows have an automatic built-in check figure. It's kind of like a trial balance. You know if you're wrong. You don't necessarily know that you haven't made any mistakes, but you have a check figure because you will always come up with your ending cash balance when you're done, and that is told to you in your balance sheet. So we'll know if we're right or wrong when we get finished with this. Okay, so we've pulled our $50,000, then we need to look at our income statement. So look at your income statement, and do you see on your income statement on page 672, do you see any gains, losses, depreciation, amortization, or depletion when you look at your income statement? Okay, so because we have some of those items, which are the gain on the sale of the plant asset and the depreciation, we need to remove the effect of those from our net income. In order to do that, we see that we had depreciation expense of $18,000. So we need to add back that depreciation expense because an expense was originally subtracted from your income. So now we need to add it back, and that zeroes out the effect of that $18,000. Then the next thing we needed to look at was the gain. It showed that, just to give us more information about the piece of equipment, it was a piece of equipment that they sold for $62,000. The book value was $54,000. We learned in our chapter about plant assets that if we received an amount above the book value, then we would have a gain. In this case, it's $8,000. So to remove the effect of that $8,000, we have to subtract that gain from our net income, again, to, as I said, to remove that effect. Okay. This is where the fun comes in, and this is where the confusing piece comes in. Next, we have to look at each of our current assets and current liabilities, everything except cash, because cash is what we're trying to reconcile to. And we have to determine if we had increases or decreases. So in accounts receivables, we had an increase in this example of $15,000. If you look at the balance sheet, we had $81,000 in 2013, and we ended the year in 2014 with $96,000. So that is a difference of $15,000. And again, it was an increase. So how does this happen? Well, we probably had $15,000 more in sales that we had not collected. Because we did not collect that, we don't have it, right? We have less cash because we didn't collect that $15,000. So that's a subtraction of $15,000. If we look at prepaid expenses, they also increased, and they increased by $1,000. And again, how does that happen? Well, we paid cash of $1,000 not deducted from net income, right? We incurred more expenses, but we haven't, I mean, they were not expenses yet because we haven't incurred them, but we paid for them, so we have less cash. So because they increased, we subtract it. And if we go back to our chart that we were looking at on page 670, again, it told us that if we had an increase in current assets, then we would subtract it. So that's the procedure for those two, and a little bit of reasoning of why. Okay, and then we had an increase, or we had a decrease in inventory. So how does a decrease in inventory happen? Well, a decrease causes an increase in cost of goods sold, right? We sold more. Okay, so because we sold more of our inventory, but there was no cash that transpired because of that, we need to add that to our net income. Are you beginning? Okay, you don't understand. I'm not doing a very good job of keeping. You don't understand why we would subtract what? Which one don't you understand why we would subtract? The accounts receivable? Ah, the gain on sale. Okay, the gain on the sale of the plant asset. What happens is, let me pop up an Excel sheet here. Lucky you're not in my face-to-face class. They're doing this project I just put here in front of your face, but let me get to a blank sheet. Okay, a gain on the sale of the asset. What they told us, let me go back to that slide. Okay, when we sold this asset, right, a gain on the sale of the asset, we would have to record that sale as we did get cash, can't really type. And we had a gain. Equipment. We would have in this entry as well, which we don't know this number, but we would have the accumulated depreciation. For that asset, right? We don't know this number. They didn't give us that number, but we don't know what the beginning value, well, maybe we do. Let me look. Plant asset. Let me see something here. 343, 219. Probably not. We probably bought something else. If we had only had the one transaction, I would have maybe been able to figure that out, but without that, I can't. So we got cash of $62,000. Our net on the equipment was $54,000. And the gain was $8,000. Okay. So this gain was not cash. It's the difference between whatever our book value was here. A gain is a non-cash transaction. It just is. A gain just is. So this cash here is going to be reported on the sale of the equipment. So the $62,000 will go under the investing section as a cell. I don't know if that helps or not, but the cash is the sale of the equipment, so it's a sale of the investment. Okay, so the $62,000 will appear down under the equipment. I can't come up right this second with some way to make you completely understand it. Right. The cash, we're not looking at the cash at this point necessarily outside of did cash come in or did that cash go out because of that. When we're doing the indirect method, we are bringing our net income back to cash basis like we didn't have accrual accounting in place. Again, this is why I say it's better if you just look at the chart and do it. So I can tell already you're a student 2, and this is not bad, but that you're a student 2 really needs to know why. And it's like the rules of accounting where I wish I could tell you why, I really do, but I can't tell you how the person came up with that back in the 14th century, but it's worked for all these years, so we need to follow them. And that's the same process with this. You know, these are the rules, this is the format. Get in the habit of doing it in the format, and you're fine. And understanding seems to come as you progress on through the courses a little better. It's really hard as an instructor. You know, you stop and you step back and you try to remember the first time you were introduced to these topics instead of that you've taught them over and over and over and over and over. And then, you try to remember, how did I feel when I first saw it? And I do remember that I just would open the books to the charts of, say, add this, subtract this, add this, subtract this. And then through the years of teaching, I've begun to wrap my head around things a little differently, but I learned from being in the classroom and watching the faces of my students that as I try to explain how it makes sense to me, it doesn't necessarily register with them because they are still at the look at the table and it tells me to add it, so I'm going to add it. And I think that's fine to do that at this point in time. We fly through so much material in this course that it's really hard to soak it all in and grasp it. So it truly is an introduction. Here it is, take what you can take from it. For the exam, you will actually not have to do, for the final exam, which is the closed book, you will not have to do a cash flow statement. So, okay. So, and for the open book exam, of course, exam 3, I'm sure there's cash flow on it, but that is open book. So make sure you know where to pull these pages, or if you're using an ebook, you may want to go through and print the pages that have the actual detail on them, and you should always have the rules of accounting by you. Always have the rules of accounting by you when you're doing an exam. Do you have the rules of accounting memorized, by the way? Do you know what all accounts increased on the debit side and which ones increased on the credit side, just off the top of your head? Very good. You're way ahead of the game if you do know that. That's great. I always think sometimes, I think that people know it better than they do, and that's project that I just popped up in front of you. I have 2 of my best students who are A students in my classes, and they are both struggling with getting everything correct in that project. And I'm thinking, I'm not sure. I'm not sure they know that everything gets debited and credited, even when they're looking at the rules of accounting. All right. So a decrease in a non-cash current asset increases cash. So inventory, we were increasing. I think we got through that. All right. So then when we get to the liabilities, liabilities follow suit. If I have a decrease in a liability, then I subtract it. If I have an increase in a liability, then I add it. So really this is pretty easy to memorize. You know, if you want to think about that, a liability follows, an increase is an increase, a decrease is a decrease. And assets behave the opposite. An increase is subtracted and a decrease is added. So in this case, accounts payable increased by $34,000. That means we have not yet spent out the cash. It's still in our bank accounts. That's an increase of $34,000. Okay. And we had salaries and wages decreased by $2,000 and accrued liabilities decreased by $2,000. So a payment of a liability decreases cash but does not affect net income, because if I pay a liability, if I pay supply or salaries payable, I would debit salaries payable, credit cash. So it doesn't affect my net income, but it does affect my cash. So again, we said if a liability decreased, we would subtract. And in that case, we had cash provided by operations of $77,000. If we want to look at investing for this section, again, this was pulled from our table. We want to look at our remember when I pulled up Excel and I was saying, yeah, I can't tell that from this. Well, here's what I was doing. The 219 minus 196 equals the 343, well, minus the 18, and they had given us the 14, so we came up with the depreciation expense, or what would have been the accumulated depreciation of $18,000 here, to show us our proceeds of $62,000. So that's all they're showing you here. They're showing you how the changes would be made in these T accounts or ledger accounts. New loans made, $21,000. Okay. And then our cash flow from the stock, again, if we issued stock, we get more. If we bought treasury stock, we have less. Through the whole process again. Long-term debt, if I make a payment on my long-term debt, that takes cash, right? I would debit my long-term debt, credit my cash, have less cash. Again, if I issued stock, I credit stock, debit cash, more cash. If I buy treasury stock, I debit treasury stock, credit cash, so less cash. Retained earnings, if I pay out dividends for retained earnings, I debit retained earnings to reduce retained earnings, credit cash to reduce my cash. So then just to practice a little bit, we can go through here and we say if we issue stock, is that financing, operating, or investing? And that happens to be financing. It gives the answer. Borrowing long-term debt. If we are borrowing long-term debt, that would become a liability. So that again is financing. Sales revenue, that will be part of our operating. Payment of dividends is part of our financing. Purchase of land with cash would be investing. Purchase of treasury stock would be financing. Paying bonds payable would be financing. Interest expense is going to be operating. Sale of equipment will be investing. Cost of goods sold is going to be part of our net income again, which makes it operating. Purchases of another company with cash, that's going to be investing. We buy another company. And making a loan is going to be investing because we are loaning someone money to earn interest off of it. We also need to note at the bottom of our cash flow statement, if we do anything investing and financing that is not for cash. So if we buy a building by issuing stock, we want to list that. Acquisitions of land by issuing a note payable. If there were cash involved, then the cash would be under the investing, but you would still note the $70,000 in the non-cash investing as an example. And then here in the slides, and as I said, you can pull these from multimedia and go through them just for another example. It walks you through another income statement, and they give you additional data so that you can finish filling out this cash flow, give you a balance sheet, and then they just walk you through, again, creating this balance sheet. Just an example. You can also use, for a really great example, the mid-chapter summary problem, which starts on page 681. It will help you to create your indirect cash flow. I'm just going to click through this because I want to look at the ending of it here. So in this example, when we get down here, we have a summary of our cash provided by operating, investing, and financing. Yes, if you go to the mid-summary, I think that you can find the mid-chapter summary problems in the study plan. Maybe, maybe not. Have you seen the mid-chapter and the end-chapter summaries in the study plan? Okay. I know that they're out there that we can assign them, but I just wasn't sure, or assign similar. Oh, okay. The problems in the study plan are the problems like in the end of the book for sure. So the end of the chapter problems, you have all the quick checks are out there, the quiz questions that are in the end of the chapter, the quick questions, the exercises, or the short exercises, the exercises, and the problems. Okay, so you've been doing the study plan. Do you do the whole study plan or random? I don't think you can actually do the whole study plan. You do the whole study plan? How many hours a week are you spending? A lot. Yeah. It takes a lot if you're doing the whole study plan. It really does, but that's great. So, I mean, I would assume you've got a decent grade in the class, right? Decent? Yes. That's great. That's great. That's a great. That is very good. I would tell you, and I don't know if you realize this or not, but this is a course that, oh, don't feel bad. You are doing a great job. Very few students get A's in this course. Maybe like in our face-to-face courses, right now I have one student in each of my face-to-face courses that has above a 90%, and that's a face-to-face. Okay, so you are doing great. Be very proud of yourself. Yeah, it's a hard course. I mean, students have trouble putting in the time. If you're doing the study plan and putting in the time and getting the points on your homework, which I'm sure you are, then you should just know that you're doing a great job, okay? Because that's great. That's very impressive. You'll be fine. You just are a student that wants to completely understand everything, and there's just not enough hours in our life to do that, right? Okay, but you're doing great, so keep up the good work. Okay, the direct method. And you know, I haven't even looked to see if you have to do a direct method. Have you looked at your homework for this chapter yet? Because you guys do different assignments than my face-to-face classes, so okay. And my face-to-face classes do a couple of short problems about direct, but they don't do a big problem with the direct method. But the thing that you need to remember is that the type of questions that you'll see on tests about this is that FASB and International Accounting Standards Board prefer the direct method of reporting. They think it provides clear information about sources and the uses of cash. It's used by the smallest percentage of companies because it requires more computations than the indirect method. It doesn't matter which method you use. The statement of cash flows gives the same information. The numbers are the same. But they like to throw test questions about which method is preferred, which method is most used. So FASB prefers the direct method, but the indirect method is the most used because it's easier for people to prepare and takes less time. And as we all know, time is money. So if you can do it in less time, that's the method they're going to use. So with the direct method, again, remember the only difference is the operating activities. The other two, the financing and investing, will be exactly the same, whichever method you do. With this, we're just going to analyze our collections from customers. We're going to look at the receipts of interest and dividends on investments and other operating receipts. And the negatives is we're going to look at payments to suppliers, payments to the employees, payments of interest and income tax, and other operating payments. Okay, those are what we're going to do. And then here's one of your best friends to do a direct method of computing the operating. We're going to look at the sales revenue plus the decrease in accounts receivable or minus the increase in accounts receivable. That's how we get the collection of cash or the receipts of cash from customers, just that simple formula. And then they show the formula for interest. And so this little chart is, if you just want to note it, in your book, is on page 686. Highly recommend this as the tool to, that's not true. That's not the page it's on. I'm telling stories. It's on page 690. This is the chart that I refer my students to use as the cheat sheet to complete these. So payments to suppliers is going to be your cost of goods sold, is your increase in inventory or the decrease in inventory, right? Plus the decrease in accounts payable. So it's just a formula that we're adding together to get these amounts that then appear on your cash flow statement as the receipts from customers, receipts of interest. So receipts of any cash and our payments out. So again, just a basic template. We're going to add collections from customers, add our interest received, subtract payments to suppliers, payments to employees, payments for income tax, and payments for interest. So using the direct method, let's classify whether these would be operating, investing, or financing. A net income is not reported on the direct method. Payment of dividends is financing. Borrowing long-term is financing. Payment to suppliers is going to go under operating. Making a loan is investing. Selling our treasury stock is financing. Depreciation expense is not reported because we're not looking at it from the income statement approach. We're looking at it using the balance sheet. And then purchase of equipment for cash is investing. If we issue stock, that is financing. We purchase another company with cash, that's investing. We pay a long-term note payable, that's financing. Payment of income taxes is going to be operating. Collections from customers is going to be operating. Accrual of interest revenue is not reported. And expiration of prepaid expense is not reported, and then a receipt of cash dividends is operating. A receipt of cash dividends is what we've earned off of our investment. That's why that receipt of those cash dividends go into operating instead of into investing or financing. When the book uses the word receipts, they mean receipt of cash. Okay? Receipts of cash when they receive cash. So then the slides are just going to walk you through, yes, receiving cash. What did they receive from their, how much cash did they receive from their customers? How much interest did they receive? Okay, cash interest did they receive? And that's what their little formulas are working through. Let me see, let me back out of this. So here with our collection of cash from customers, that would be our receipts from customers, right? And this was where you would start with your sales revenue and you would add any decrease or decrease in accounts receivable or subtract an increase in accounts receivable, whichever it were. In this example, we had an increase of accounts receivable of $15,000, so we subtracted that from our sales, okay? You say okay, but I'm not sure. Not sure. So again, these examples, have you read this chapter? Did you try to read the chapter? Okay. Do you usually read the chapters? Okay, good. I think that as you go through and read the chapter and look at the examples, it will make even more sense. But again, if you need to do an indirect method, then use the mid-chapter summary problem as an example. And if you need to do a direct, then the end of the chapter summary is really, really good. One of the complaints I get all the time and hear all the time, even from students on here, and I don't know if you've ever been in one of the webinars or not, but they'll say there's no good examples, and I can flip to the book and it looks to me like there's good examples. So I think that maybe the way my accounting lab sets it up makes it look a little different than what the book makes it look sometimes. So at any rate. So this is just walking you through each one. And then free cash flow, just a formula, net cash provided by operating activities minus any cash payments earmarked for investments in plant assets. And that's the end of the slide. Let me pop up here the class and we'll look at a couple of things real quick. I can't remember if on this computer I can get into it on Chrome or not. We'll see. Use too many computers. Each webinar is different. I do a webinar each week. So I do, well, I say each week. I usually do a webinar each week. I was gone to Afghanistan for 3 weeks this semester, so I did not do new webinars. I actually have webinars posted out there. You can find those. If you go to the link in Campus Connect and click into where you went to register, and then you go in down at the bottom, you can click into Accounting 101. You can see the webinars for each chapter and then also for the reviews. And they're out there from last semester, which was the same textbook, so the same material, and then the ones that I've put out there for this semester. So every webinar is different. Okay, each chapter. So next week we would do chapter 13, and then I will do a review for exam 3. And then that's probably it. I don't know if I'll do a review for, I probably won't do a final exam review. We'll probably do a review for exam 3 and maybe the final review at the same time. I suppose I could post 2, but we'll see. We'll see. I don't know how the time frame goes. I'm not that far ahead of the game. I'm kind of live by the moment kind of girl right now. It's not a good thing, is it? Okay, I just have a lot of things on my plate, and just like students. So I'm going to just look real quick to see what type of assignments you have to do this week in this class. I haven't done that yet, and so we can pull up and give you a little heads up there. Okay. I want to look at the problem assignment. So for the homework for the homework assignment itself, you do 2 problems. You do one that is direct method and one that is indirect method. So you would look at 2 separate problems. So one of each type. Let's see. For your exercises, you've got three exercises for direct method and 3 for indirect, and I can't even count. 4 for indirect and 1 for the direct method. So it's going to touch. Okay, I'll show you where the webinars are. Just a second. So you're going to do both methods. So that's kind of nice to know. I wanted to look before I leave here. Ugh. I'm actually going to leave here because I don't. The Include Ed class is the way that my accounting lab works, and it's just because I'm spoiled because I don't use it that way for my other classes, but I cannot maneuver through it as well. Let's go to campus. It's actually not Campus Connect. It's ivtech.edu. Okay, so if you go to ivtech.edu, this is just the general Ivy Tech page that everybody can get to in the whole world, okay? And then there's an Ivy Tech Online up here at the top. Can you see this? And I'm taking you to where you find the webinars. Okay, Ivy Tech Online. And then over here on the side, there's something called Live Sessions. If you click on the Live Sessions, this is the page that I believe that you were taken to the register for the webinars, and you have to register for every webinar separately. Then down here at the bottom, all of these courses, if it says there's statewide online content in these courses, and there's some instructor like me out here doing a lecture each week, so you can go watch any of these lectures. But if you click on the Accounting 101 there, it's going to take you to YouTube, and here they all are. So here's my last fall ones. And you know, I started naming them. I finally got smart 2 weeks ago, right? Looks like 3 weeks ago. I finally started calling them what they are instead of it just having the date. Yeah, so did you just now hear about the lectures? See, I tell them at central office. And did you get another email, or how did you hear about it? Okay. I was just at a conference where the statewide people were, and I complained again, and I said, students do not know. I said, students don't know these things are available. Yeah. That's what I keep telling them. Okay, we're putting this information out here, but people don't know. And I'm sharing this. Ah, all right. So do you think it's useful at all? Yeah. I tell students that just hearing the terminology sometimes can be very, very helpful. And I think the thought process behind these online seminars, which started in the fall, the thought process was that there's so many of you statewide, students taking these statewide online courses, and then you just feel so alone. And the thought was to try to bring people together, but I just keep telling them, I said, students don't know, so it's just, I mean, I'm just a program chair from Richmond. I teach accounting, business, whatever I teach, but I was doing this for one of my classes personally, and when they asked someone, I just said, well, I'm doing it anyway, so I might as well do it. But I think it's good. I mean, and I will tell you, some of these are better than others. I have some subjects that I can really get into, and then I have some topics I have some really good examples for from my years of teaching. And then there's times when I get here and I'm so tired I don't know my name, and I'm sure I mutter around. But but I think it's a great thing. So at any rate, that's where they're at. Okay, so you can go out here and find it. And I share these with my face-to-face students too, because if they're doing, they may be doing an online one of these other courses and they're struggling and they don't even know they're there. And so I think it's a good thing. So they're there, like, as I said, last fall's and this year's too. So like I do the lecture live and then it gets posted to YouTube, usually the next day. Sometimes it takes a day or two, but they're there. So maybe you'll find some use in those. At any rate, I wanted to also go and look, so that's ibtech.edu. And if you wanted to register for more of the webinars there, you just go register for each one. I wish you could just register for them all at once, but it doesn't seem to be the way it works. And then I'm going to go back here to my accounting lab. Oh, not my accounting lab. I don't want my accounting lab. I'm going to go back to Blackboard a second. No, you don't need to read Chapter 11. We're not doing Chapter 11. We've pulled that out. Okay? You don't have to read 11. So I'm going to go back to class sessions here because I don't want you stressing about the final, and I want to share how much you can do to make your life easier with that final. And you can start doing it now. So if you go to session 15, class session 15, and you scroll down, you will find the final exam study guide. This is very detailed. So if you open the study guide, it tells you what you need to know from Chapter 1, what you need to know from Chapter 2, what you need to know from Chapter 3, etc., right down through. Okay? So see Chapter 12, the one we're just doing right now. You need to know what is the purpose of the statement of cash flows. How could you identify the indirect method from the direct method? And that'll be something like, it'll start with net income in the operating system or section, something like that. And you need to know the 3 activities, which you can probably name those for me right now: operating, investing, and financing, right? So this should help you see that, I hope this helps you see that you print this study guide out, you answer these questions, you study it, then you're going to go take this proctored exam. That is not timed, but it won't take you very long. It's an exam in Blackboard, not in my accounting lab. So, you're not jumping through all of the different levels. They're multiple choice questions. So, does that look like it's doable? Yeah. So here's what I would go ahead and try to answer these, start through this and get these questions, answered, so that if you have questions about it, I'll do something. If it's the week that I'm doing the week 3 exam or whatever, I'll say, and I may start doing that each week, is anyone working on the study guide, have any questions about what it's asking you for on the study guide? And And if you do, we can start answering those questions so that you can study for it, because there's no reason for a student not to do a good job on this final exam if they do this. I will point out that some of these are answered, not really questioned. If we look at Chapter 1, it tells us, or number 4 here, it says FASB, responsible for gap, right? That's an answer to one of the questions. You know, they're not asking you to come up with anything. That's an answer. So, you know, it's really doable. I mean, I don't know what else to tell you except it's really doable. It's worth a lot of points, but if you prepare, you can do it. So, good. You won't have any trouble. Another thing that I think, I mean, if you just are afraid, and some people just get themselves so worked up, not afraid, but, you know, the normal test anxiety thing. But pretty historically, a student walks into the final exam, and if they've got 85% in the class, and they get about an 85% on the exam. You know, if they have in your case, you know, with your percentage, you could expect to earn that percentage, right? And so it's great. So tell your classmates to go out and sign up for this. Do you talk to any of your classmates at all? Nope. What region are you in? Sellersburg. You know, I do get a few students log in from Sellersburg along. Who's your instructor? Kim Martin. Okay, I don't know her. All right, I know the program chairs, but I don't know all of the individual instructors. So, okay, do you have any other questions for tonight, or do you think you're good? You're looking over your issues. All right. And another thing that you can do if you would like is, do you use Blackboard IM at all? Does your instructor encourage Blackboard IM? Okay. Well, you're welcome to add me, and I have a full-time faculty as well. I can give you both of our usernames. If you want to add us, you can just go to contacts and add contact, and I am K Tower. Let me see. I'll put it in the box. K Tower, and Jenna is J Hampton 38. So my IM, Blackboard IM is K Tower, and Jenna is J Hampton 38. We tried to be online on Blackboard IM a lot. I would tell you we both do taxes outside of Ivy Tech, so we are winding down on our tax week, so life should return to normal a little more next week for us both. So at any rate in time, I mean, we try to be on Blackboard IM a lot, and we're committed to be on Blackboard IM more, as we both have face-to-face students working on this project that they're struggling with. So feel free to add us as contacts, and then if you have a question and you see us online, you know, we're more than happy to help any accounting student anywhere and try to resolve your problems. We both teach a lot of Accounting 101 sections. We know it inside and out. We both teach for IU East, their beginning accounting class 2, so we teach a lot of Accounting 101, and we can answer your questions pretty quickly, okay? Okay, well, Exam 3 is going to cover 9, 10, and 12, I believe. Let me look. 11 just got taken out fairly recently. But it should be 9, 10, and 12. Yeah, 9, 10, and 12. Exam 3 is 9, 10, and 12. Right. Yep, that exam is also open book. I'm sure you'll be fine. The only thing that catches people is the time. So, you know, I think that you're someone who studies and prepares before you click into a test anyway, and you know, to have the information that you might need to refer to either printed out or so that you can quickly reference it during the test. So, all right. Thank you so much. I hope you gained something from this, and you know, if you maybe you'll want to go back and just view the chapter 9 and 10 videos real quick before you move forward with the test. But we'll do a review next week. All right. Thank you. I'll see you next time. Good night.